Hey, this is Casey Long, Strategic Mortgage Solutions, here for the Tuesday Mortgage Talk. I just want to talk about a couple points I think are really interesting. I'm going to talk a little bit about the upcoming big changes that VA has in stock for itself for 2020, but I also want to talk about an interesting rent versus buy statistic that I think really better captivates or captures the true value of home ownership versus renting. Anyway, I'm going to go into that statistic really quick. So what got me going on this was I read a financial planning article that talks about how home ownership and the value proposition and building wealth is overstated versus people that rent, and that oftentimes people are far better off renting than owning. And in many cases, I'm sure that's 100% true, but there are quite a few cases, and I would say probably a majority of them where that wouldn't be the case. And the reason why I say that is because one thing that a renter never has control of is the cost of rent. Rent will go up based off what the market dictates that rent should go up and the landlord feels like charging. And that's something that the tenant hasn't got any sort of control over. And to that point, if we look back on statistics, you can look back on Zillow, for instance, where I found some interesting statistics. 10 years ago, the median price of rent was $1,060. Today, it's up to about $1,600. That's a 30% increase over that 10-year period of time, but annually, that's about a 3.5% increase, which is pretty amazing, actually, if you think about it, is that year over year, the cost of rent is just going up, up, and up. So I thought to myself, wasn't that interesting? You're seeing rent overall go up by 3.5%. But what people don't think about when they're buying a house is how they're locking in about 85% of their house payment with something like a 30-year mortgage. And right today, we could offer somebody with the right credit profile, of course, and we've got some statistics about that on our Facebook page and our offered rates. But today, if somebody were looking to buy a $275,000 house, put 5% down and get a conventional on, they could get a rate something like 3.875. With certain assumptions about property taxes and insurance adding up to, say, $4,000 a year, that home buyer could get a payment today of $1,619, counting mortgage insurance and that. What's amazing is over a course of 10 years, they'll see their property tax insurance go up, but at some point, if they make their minimum payments between 9 and year 10, the MI goes away. And they're left at that point with a payment of right around $1,676. So really, their payment's only gone up by about $40 or more, or maybe just a little bit more, with the assumptions that taxes going up 3 and 8% a year and so forth. Now, a renter, on the other hand, if they were to continue to rent, and their rent started at $1,600 a month, which is the median rent, I think is right a reasonable assumption for a house that might be priced around $275 today if they were to rent. If that house rent were to continue to annually go up 3.5%, by year 10, they could be paying about $2,080 in rent. When you think about that, that's about a $400 a month difference between the person that bought a house today and made the mortgage payments, kept the house, never refinanced, just kept the mortgage and just went about their way, versus somebody that rented. Now check this out. If we kept going on an additional 5 years to year 15, now that renter versus that homeowner, an even bigger difference. Now the net cash flow after paying the mortgage payment is a difference of $932 a month between what the renter's paying and what that homeowner potentially would be paying, making all those assumptions. So you can't tell me that home ownership doesn't allow for wealth building. A lot of times it's not necessarily what the house is worth, because they've always got to have shelter over themselves. A lot of times it's the generation of locking in locking in a majority of the house payment costs and seeing the benefit of their income rising and having more disposable income to fund other financial goals that they have, such as investing in their 401k, where maybe they get a match. Hey, maybe it gives them an opportunity to save for the college education for their child. The odds are a homeowner is going to have a better propensity to be able to save 10 years, 15 years from now than that renter would be. Now, to go on to VA. VA made a couple interesting changes that I think you should be aware of. VA, for one, the number one big change that really pops out of my mind is that they no longer have a loan limit in terms of their no money down program. You see, before VA, before 2020, when this goes into effect, VA has always had some sort of guideline about the requirements for no money down, meaning the loan amount could not exceed conventional loan limits. Right now, around here, it's right around $480,000 and some dollars. But once 2020 hits in January, there'll be no loan limit, meaning that somebody that before was borrowing more than the conventional loan limit, for every $1,000 they borrowed more, they had to come to closing with a $250 down payment. So if you were borrowing, say, $100,000 more than the loan limit, you actually had to have an additional $25,000 of equity into the deal in order to make it work for the VA loan. So it went from being a no money down loan to a some money down loan. Now, another big change that happened is that now, before, only people that were exempt from the VA funding fee were people that were considered to be partially or fully disabled by VA through their service. Now, people that have been awarded the Purple Heart are also considered to be exempt from the VA funding fee starting January 1st of 2020. Finally, the VA funding fee, and this is a little bit of a downer, but of course it's meant to probably absorb some of the additional risks of not having certain loan limit restrictions and down payment restrictions, is that the VA funding fee is going up a little bit. For first-time users, it goes from 2.15% added on top of the loan to 2.3% now added on top of their loan, or they can come to cash with close. For subsequent users, where they are trying to get 100% financing, their VA funding fee is going from 3.3% to 3.6%. So a little higher jump over there. Anyway, that's it. If you have any questions, give me a call. Thanks for your time. Bye.